Cast is now starting. All attendees are in listen-only mode.
Hi and welcome everyone to our James Cooper webinar covering yesterday's autumn budget. This was a budget targeted very much at the end of austerity, and whilst it's marked a policy change for the Chancellor by announcing billions of pounds of extra funding and brought forward tax cuts for millions of individuals, there's also been a significant amount from a tax perspective in terms of the detail that's come out. As is usual with the case with these budgets, a lot of the detail is hidden in the publications that get released separately compared to what's announced. And the purpose of today's webinar is to work our way through a lot of these additional tax announcements that have been released in these other publications. So whilst this was, very much a review aimed at additional spending for the health service, for MOD, mental health, education, there was even money set aside for transport and potholes. And the impact on businesses is quite significant, with a number of different changes coming through. I think the one major caveat to the budget yesterday was around Brexit. So whilst there's very little change as a result of the budget towards kind of Brexit, fundamentally the Chancellor is banking on a smooth Brexit. What's interesting is that there's the possibility of a return back to a spring budget depending on the outcome. So just as an introduction, my name's Phil Snell. I'm a business tax director based in our Reading office. So for today, I'll be going through the corporate tax and business tax specific measures that are announced. I've also got Penny here with me as well.
Hello, I'm Penny White. I work in the private client tax department based in Newbury and Oxford offices, and I will be looking at the income tax and VAT side of the announcements yesterday.
So moving swiftly on to corporation tax, I think as expected there wasn't any change to the main rate of corporation tax. I think it's still very much seen as a competitive rate, and there's still an expectation that this will come down to 17% in April 2020. What was a common theme throughout this budget is that there is actually a reinstatement of certain past measures, one of which is in relation to the corporate intangibles reform. Corporate intangibles is typically when you're looking at goodwill, so this is intellectual property of businesses. And what has happened previously was that there was a restriction in the amount of goodwill that could be deducted for tax purposes where that was acquired on or after the 8th of July 2015. What they're moving to is that with effect from April 19, there will be a reinstatement of some of that relief associated with purchased goodwill. For this, we're expecting further details to be published on the 7th of November with a consultation period that will follow. So whilst this is a positive step, we do need to wait and see what's included in that detail as to how far this will go. Separately, there's also a change to the degrouping charges. Now, this is something that is expected to apply as soon as the legislation is published in November. There's currently a mismatch between capital gains and the intangibles regime, and this change is looking to align the two. What fundamentally happens at the moment is that for certain assets that fall within the old capital gains tax regime, you can make disposals of these without incurring a degrouping charge through the use of an SSE, a substantial shareholdings exemption. What has happened currently is that where you have a degrouping charge in relation to an intangible, that same mechanism hasn't applied. And what's expected to change is that there'll be an alignment of the two, such that you don't get this mismatch between the two different treatments. Capital allowances is one of those areas that's often picked up as part of the budget. There's typically lots of changes that come through, and this budget is no different. Capital allowances is effectively a depreciation for tax purposes. There are two slides to cover this, given the number of changes. The first is a relatively big increase in the AIA, the annual investment allowance, from 200,000 to 1 million for a temporary 2-year period starting from 1st of January 19. AIA is one of those areas that the government have moved around in previous years a number of times, and it's not unsurprising to see that change yet again. For a lot of SMEs, what we see is that typically they actually don't make use of the full 250,000 limit at the moment, and therefore this may not be such a significant impact to them. In addition, this is very much a timing difference. So whilst it's still a welcome change, it's something that you would ultimately get relief for over a period of time. Separate to that, or as an opposite impact of that, there's a reduction in the rate of the special rate pool. So as a reminder, there are two rates for capital gain, for capital allowances. You've got your main pool, which is unaffected and continues to be at the 18%. And then you've got your special rate pool, which is going to be reduced from the current rate of 8% to 6%. Interestingly, we looked at the length of time that it would take you to claim full relief, or over 95% relief for assets that go into your special rate pool. And this is actually works out to be in excess of 25 years. The key thing here will be about maximising your annual investment allowance to offset against those assets in the first instance. Care really needs to be taken when it comes to company cars. So for company cars that have got CO2 emissions above 110, these fall into the special rate pool. But for company cars, you can't claim any annual investment allowance. One of the most significant changes since the removal of industrial buildings allowance is the reintroduction of a very similar mechanism, which is going to be called structures and buildings allowance. This will apply relatively soon for all additions that are incurred after the budget. And what this seeks to do is to give relief for structures. So this is going to be typically things like offices, factories. It doesn't include land or residential dwellings. And the rate is relatively limited at 2%, but that's to reflect the underlying life expectancy of these types of assets. It's a welcome addition in the sense that most of these additions would have been treated as non-qualifying with no relief. So to have that brought in is a significant change. As a couple of minor points, electrical charging points, there's going to be 100% first year allowance introduced for those, for people who are installing those at work. And there's also going to be an end to the enhanced allowances for environmentally friendly technologies. This was something whereby if you fitted into a prescribed list of assets, you could claim 100% relief in the year of acquisition. It sounds like a negative change in terms of what's happening, but I think in reality, these were probably rarely used, and in practice, we actually didn't see that many people making these claims. I think it's something that's important to note is that the Chancellor made a lot around its commitment and their commitment to innovation within the UK. He's keen to point out that there's been an increase of over 7 billion since 2016 on innovation and funding in the UK. There was lots talked about in terms of these additional kind of initiatives that are going to be encouraged, whether it comes from the Internet of Things or R&D or innovation. What's interesting is that based on a survey back in 2016, which is the picture on the right-hand side of the slide, our R&D kind of spend as a percentage of GDP still lags behind countries such as Germany. So whilst this is a good sign, there's still hopefully more to come in the future. Looking specifically at R&D tax credits, there's been a change that will have a significant impact on certain SMEs. Again, this is something that was removed previously and is now being brought back in. It's seen as an anti-avoidance provision where people were looking to abuse R&D tax credits. But interestingly, it won't be brought back in until accounting periods beginning on or after 1st of April 2020. And the change is to limit the amount of payable cash tax credit for loss-making companies to 3 times their total PAYE and NIC contributions for the period. It's a significant change for certain businesses, and they're going to be the ones that subcontract the majority of their R&D. So if you have a low staff headcount, particularly some startup businesses where they might not necessarily be charging salaries to the founders, there is a risk that actually this would have a significant impact. There will be a consultation period, and therefore it's hoped that there might be situations where, where the R&D is subcontracted and it is genuine R&D, there can be something done to help those particular businesses. I guess as a quick reminder, there's no changes to the large company scheme. So for an SME, broadly, you can get about a third of your spend back as a cash tax credit. For large companies that are loss-making, that's closer to 10%. And therefore that's remained unchanged. Further significant changes that have been made are in relation to entrepreneurs' relief. There was obviously quite a lot of speculation before the budget as to whether or not the Chancellor might go one step further and abolish entrepreneurs' relief in its entirety. It's welcome that the Chancellor noted that it is an important relief, and therefore it is here to stay. However, there are two key changes that will be coming through. At the moment, entrepreneurs' relief applies where you have a company, typically, or assets that are used in a company that you control, whereby you can get a special rate of 10% applying to any gains that you make on those disposals. You have to meet certain qualifying criteria, and currently the ownership period is only 12 months. And it's been seen that this was kind of an easy, and there were the ways of this being open to abuse, and therefore it's been extended, the qualifying ownership period, from 1 year to 2 years, and that applies for disposals on or after 6th of April 19. So there would be a period of time between now and April for those that might qualify to look to claim entrepreneurs' relief without having that 2-year ownership period. A more critical change that was introduced with immediate effect was around the need to have 5% of the distributable profits and net assets of the business. What's happened historically is that you could arrange the shares in the business such that you had 5% of the votes and 5% of the nominal values needed to fall within entrepreneurs' relief, but without having genuine 5% interest in the business. I think this is something that, there has been moves in the past to try and prevent people from doing this. And therefore, they've made it very clear cut that in order to qualify for entrepreneurs' relief, you need to have a genuine 5% economic interest in the business. There'll be a lot of people who will fall into that from previous transactions who unfortunately now won't qualify for entrepreneurs' relief. Given that it does apply immediately to disposals on or after 29th of October, so yesterday. There is a minor change to relief where you've got a founder who's been diluted below the 5% threshold. I think this will be relatively limited. The effect of it is to bank some of the gain on those shares that are retained. So you effectively can hold over some of that gain at the 10% rate. Any increase in value after that date would still be subject to normal capital gains. So I suspect that it is of some use, but relatively limited. From an employment taxes perspective, something that's already been introduced for the public sector a few years ago, and there were consultation documents on that was therefore widely expected, is the introduction of changes to IR35, which is effectively to move the responsibility for determining whether or not someone is self-employed or employed to the private sector, to the company that is engaging with them. And that's irrespective of whether they're then employed through a personal service company. This will be a really big change to businesses who historically have looked at this and said, if we employ someone who uses a personal service company, the risk is effectively pushed on to that personal service company to make a determination of whether the individual should be treated as self-employed or not. As I say, this raised a significant amount of money in the public sector, I think over 500 million, and therefore it was something that was widely expected. Moving the onus onto businesses to determine whether or not these individuals are self-employed or not, absent that personal service company, will be a big change. Luckily, these won't be introduced till 2020, and there will be a consultation period that continues. But it's something that businesses really do need to start thinking about sooner rather than later. Some other kind of minor points that came through. There is an employment allowance that's going to be tweaked so that it's only available to certain businesses who have national insurance contributions under 100,000. I suspect, in looking at the numbers, we think that this will apply to businesses who have got payroll in the region of about 1 million. So anything less than that, this would apply to. Otherwise, anything above that would no longer qualify. And as announced previously, there'll be no removal of the Class 2 national insurance contribution. That's here to stay, at least for the foreseeable time. And then just to quickly on the final bullet point on there, there'll be, whilst there's no changes to kind of benefits, and in particular in relation to company cars, there are new worldwide harmonised emissions tests that are being introduced, and these will be applicable from April 2020. And what these effectively mean is it makes it much harder for manufacturers to meet their existing kind of miles to the gallon and CO2 emissions. So the changes to those rates could push some cars up a band when it comes to looking at things like benefits in kind for company cars. So one to watch just in terms of how that will change in the future. A relatively big change that will actually only impact very few businesses is the introduction of a digital services tax. And the Chancellor talked very much about wanting to have a global approach to this, and that's still very much hoped that that will become the case in terms of the kind of previous OECD initiatives. But there's been so much in the press about the likes of Google and Facebook not paying enough tax that it's probably felt that the Chancellor had to try and introduce something, in the meantime, while we wait for that global approach. So he very much talked about this as being a temporary issue until a more global approach can be adopted. What it effectively means is that there'll be a new 2% of revenue tax, and this will only really apply to turnovers, to businesses with turnovers of more than 500 million. And therefore, there is an aim at trying to identify certain businesses that this will apply to. I think there's also relief for online retailers, so that you're not capturing the wrong types of people who have genuine UK presence and pay genuine UK taxes already. Just a quick one on making tax digital, in particular from a VAT perspective. There was nothing further announced on this, so making tax digital is still coming. We knew previously that this would apply to taxable businesses from 1st of April 19. There was already a slight deferral introduced to 1st of October for complex VAT, and therefore it's worth looking, depending on your circumstances, whether or not you can fall into that. The time is very much to act now. We've spoken to so many businesses about this, and it becomes a really hot topic. And therefore, if you've not yet thought about how you might be dealing with this, it's worth talking to someone. If you're using a software provider, such as Xero or Sage, then chances are you are okay, because these software providers have been going through a process in order to create a solution that will work with the revenue. What's important to note is that from 1st of April 19, what's being introduced is actually fairly limited. There are further changes to come for 2020, whereby there'll be a greater requirement on the amount of information that's provided and the way in which it's dealt with. So the case is not to kind of get complacent, to make sure that this still stays on the agenda. There is still talk of corporate tax and income tax being introduced from April 2020, but we'll have to see whether or not that actually happens, given all the other changes that are going on. This was another change that we actually already knew about in advance. It was originally announced in the autumn budget of 2017, and we've seen draft legislation that's been published in respect of this, although there will be further to come. What this is effectively looking at is a couple of different things. One is that non-resident corporate landlords were historically charged to income tax on rental income, which has always felt a bit odd. And they'll move to being charged to corporation tax, which means they'll be charged at 17% going forwards rather than the 20% for income tax. Separately, there will be a change such that pretty much all UK land and properties are subject to UK tax. Historically, we've had legislation introduced that has ensured that residential properties are already subject to tax, irrespective of being owned by an overseas company. But these changes will also mean that overseas property owners will also be subject to UK tax on their disposals. That move is very much in line with how overseas territories tax immovable property, and therefore this is probably just around moving in line with how overseas territories tend to work. A couple of minor points, very much aimed at helping small shops and independent retailers on the high street, is a reduction in business rates for the next 2 years. I think the intention is at the end of that 2-year period there'll be a rebasing, and therefore we'd look to see how that will pan out. Separately, the apprenticeship levy is being tweaked slightly. At the moment, where you employ apprenticeships, you can get into a situation whereby the government pays for 90% and you pay for the 10%. And that's being changed for certain SMEs, so that the contribution from the SME is only 5%. It's minor, but it's going to be welcome for those smaller companies that qualify who employ apprenticeships. So just on the final slide from me, there was a whole raft of other anti-avoidance measures. These are something that is a continuation of what the UK government have been seeking to strive to achieve through both the OECD initiatives, but also just generally across the board in terms of trying to make sure that the right amount of tax is paid. I think one of the interesting ones to highlight that, again, was in the detail but it was easily to go unmissed, is a change to the corporate loss relief rules. At the moment, capital losses can be relieved 100% against any chargeable gains in subsequent periods. So if you've got brought forward capital losses and you make a chargeable gain in a subsequent period, at the moment you can offset 100% of that of those losses. From 1st of April 2020, it's proposed that amounts in excess of 5 million will be restricted to 50%. So that's amounts of brought forward losses. If you've got those that are in excess of 5 million and you want to offset those against a capital gain in a future period, anything over that 5 million will be restricted to 50%. And I think that's quite a significant change for certain businesses who have historically had significant capital losses and who are then looking in the future at making gains, maybe on the disposal of their offices or factories, that you may find a situation whereby you can't make use of all of those capital losses. So whilst this brings the capital losses in line with the other loss relief rules for normal trading losses or interest expenses, it is quite a significant change that could have an impact on certain businesses, and one just to watch out for.
Thanks very much, Phil. We'll now move on then to have a look at some of the tax changes affecting individuals, in some cases trusts. We'll begin by having a look at the income tax rates and allowances, and I suppose this is the headliner from the budget because it affects most individuals within the UK. So the personal allowance will be rising to £12,500, not as expected from April 2020, but from April 2019. And the Chancellor quite famously, I think, said that puts £130 a year into most individuals' pockets within the UK because they earn at least £12,500 or have an income of that level. He's also announced the change to the basic rate band will come in on the same date, which means that you can earn up to £50,000 and only be paying the 20% basic rate of tax. After that, after April 2020, future tax increases will be made in line with CPI. It is perfectly possible, of course, that in April 2020 we'll have a new rate announced, depending on what the Chancellor wishes to do. Just to note that the basic and higher rate limits don't apply in Scotland. The personal allowance applies across the UK. Moving on to the impact of these tax rates and allowances for the very well-off. Those who have an income of more than 125,000 don't actually benefit from the personal allowance at all, because that's the point at which you lose your personal allowance entirely. That means that they do benefit from the increase in the higher rate threshold, but they're actually not benefiting from the increase in the personal allowance. It is possible with tax planning to recover that personal allowance, perhaps by making a pension contribution or a gift aid contribution, so do talk to your tax advisor about that if you'd like help with that. Other tax rates have not been changed within this budget as expected, so the tax rates remain 20, 40 and 45%, and the rates on dividends are the same. You can receive a dividend of up to £2,000 tax-free, and the additional rate threshold remains at £150,000. The final bullet point on this slide, the government was thinking of looking again at the shared occupancy test and to actually legislate for the fact that rent-to-room relief will apply where the landlord and the lodger occupy the property at the same time. They decided not to legislate, but are going to clarify their intention. As I understand it, this is because people have been using rent-to-room relief where they actually go away on holiday and let people rent out their home, and that isn't what HMRC had intended for the relief initially. But we will watch the space on this one. Moving on to look at capital gains tax, the annual exemption is increased by a very small amount from April 19, or will increase a small amount from April 19 of £300. No other changes here, apart from the change for the rate of tax for non-residents owning UK immovable property, land and buildings within the UK. Up until April 19, tax is paid for residential property at the rate of 28%, but from April 19 onwards, this will be changed to include commercial as well as residential property, and probably quite surprisingly actually, to bring in property companies that are largely investment companies where 75% or more of their value relates to UK property. So this capital gains tax rate will apply to disposals of shares in those companies. Moving on to other changes within capital gains tax, HMRC have been talking for some time about changing the tax payment date for capital gains tax. At the moment, it's usually paid by the 31st of January following the end of the tax year of the disposal. HMRC had called for people's responses to changing that date to a 30-day deadline, 30 days from the date of completion of a disposal of a property, and indeed now are planning to bring that into law from April 2019 for non-residents and April 2020 for UK residents. This will probably be aligned with online reporting of the gains to be made. It is going to become even more important than it already is then when you dispose of a property, not only to work with your lawyer, who generally won't advise on tax in these areas, but also to liaise with your accountant or tax advisor and to make sure that they are aware that you have sold your residential property, to make sure that the tax will be paid in time and avoid penalties and late payment interest on that. The next area that we need to have a look at is capital gains tax changes in relation to disposals of your main residence, your own home. The final period of ownership of a residential property, so when you sell your own home, used to be 3 years that you would be exempt from capital gains tax, and that's been reduced recently to 18 months. I think that was in 2014 that came in. Yesterday's budget announced that that final period exemption will be reduced to a period of only 9 months, effective April 2020. This was originally introduced to allow for the fact that between moving out and selling a property, there was likely to be a delay because generally it would be perhaps take you some time to sell your property because of the market forces. I suppose the reduction to 9 months is reflecting the fact that perhaps property markets have speeded up. There won't be any change, however, if you leave your home to move into a care home or if you're a disabled person. The 36 months exemption for the final 3 years of ownership still applies. HMRC were looking at lettings relief before this budget, and they have made what I think here is a substantial change to the lettings relief. Up until now, lettings relief is available at a maximum of £40,000 per person, where, as well as having been your main residence at some time during your ownership, you have also let the property out. And so what was quite common was perhaps for someone to own a property, buy a new one, move into that, and then let out their former home, and to get some quite substantial capital gains tax exemptions as a result. HMRC is changing the rules on this, so the lettings relief will only apply to the periods where the landlord and tenant, no tenant, not lodger, landlord and tenant occupy the property at the same time. This also comes in from April 2020. Government's going to consult on this, and it'll be really interesting to see what people think of it. It'll be interesting to see whether there are substantial changes to this relief before it is brought into legislation. Moving on now to have a look at some changes in relation to other aspects. Well, the next slide actually is no changes. No changes on the inheritance tax rules. Your nil rate band remains £325,000 per person. The residence nil rate band will go up as expected to £150,000 from April 2019. The residence nil rate band is there to allow people to leave their home to their direct descendants, so children, grandchildren, and so on. There are downsizing rules that apply. They're quite complex to apply, so it's a good idea to get tax advice on this. So downsizing means that you can actually sell your main home, and as long as the proceeds from selling your home remain in your estate when you die, you can still claim the residence nil rate band that's available in that tax year. The ISA allowances remain. £20,000 from 6th April 18 is going to be unchanged at April 19, and up to £4,000 of that can be into a lifetime ISA. The junior ISA funds and so on remain, and the child tax fund is going to retain its tax-free status even after it matures when the child reaches 18. One thing that we are very, very pleased to see in this budget is that the annual allowance pension cap, £40,000, remains. So there's no reduction to this. We can carry on making contributions to pension funds of up to £40,000 per year, provided you have the relevant earnings to substantiate it. And the lifetimes allowance is increasing now in line with consumer prices index, the CPI, so will go up from April 19 to 1.05 million, just above. HMRC is looking at trusts. They say they want to make the taxation of trusts simple, fair, and so on. I'll be interested to see what they come up with here. They are tweaking a couple of the rules in relation to trusts, in particular from April 2019. Property that has been introduced to a trust by a UK domiciled individual when they were not UK domiciled will no longer be excluded property. Excluded property has some advantages from a tax point of view, so quite a significant change there. Moving on to have a look at charities. Charities are exempt from tax on trading income of up to £8,000 where their turnover is under £20,000, and up to £80,000 where turnover exceeds £200,000. There's been a tiny increase to the gift aid small donation scheme, so this is where the charity doesn't need to worry about the gift aid donations forms being completed, but the individual donations limit has been increased to £30 from £20. In addition to this, the retailing don't actually have to let donors know by letter what contributions have been made if the annual donations are worth less than £20. So that is there to try and reduce the administration for charities, because of course it is quite expensive these days to send out those letters and so on. Moving on next to VAT. The VAT threshold will remain at £85,000 for another 2 years until April 2022. HMRC are going to introduce a fraud combating measure, which is the VAT fraud in labour provision. This relates to missing traders, so a trader who will issue a tax invoice, collect the VAT from the person they've sold to, but magically disappear before they've actually been able to pay that VAT over to HMRC. And they're going to use a reverse charge mechanism for that. The Chancellor made much of the fact that he is unable, because of EU rules, to zero rate VAT on armistice memorabilia and such like, but the fact that he would actually be able to reinvest the money that comes from charging VAT on those things, so £10 million donation to support veterans, and grants available for village hall refurbishments equivalent to the VAT on those. Another couple of changes on the VAT side, so government changing the rules on VAT treatment of prepayments, even where the goods are not collected, and quite helpfully legislative changes so that non-corporate members of a group will be allowed to join within a VAT group registration. Our VAT team are always very happy to help you with VAT questions, so do get in touch with them if those are areas that you need help with. We usually have some interest in the changes to duties within a budget, so the duties on beer, cider, spirits have been frozen. For wine drinkers, rises in line with inflation from Feb 19. And white ciders are going to have a new higher rate from Feb 19 too. Tobacco, duties are increasing on both of those. Happened last night, so too late to take advantage of those now. Fuel duty remains frozen, and the vehicle excise duty is going up in line with RPI. No change to the HGV, heavy goods vehicle excise duty, that's frozen for another year, 2019-20. A couple more duties to have a look at. So there's an increase in the online gaming duty, 21% from October 19. No changes to the air passenger duty for short-haul flights, but the air passenger duty on long-haul flights will be going up in line with RPI from, that's the retail prices index, from 2020-21. And the final measure that we had here was having a look at our plastic tax, so targeting the use of single-use plastics, which of course has had lots of publicity in recent times, not least from David Attenborough's programmes on the TV. So from 2022, there will be a tax for the production or import of any plastic that doesn't actually contain a measure of recycled plastic, so about 30%. HMRC were considering looking at the tax on takeaway coffee cups, but have decided to give all of the industry contributors some time to make progress on recycling. And as I expect you would have noticed when you go to your favourite shop to buy your coffee, you are being encouraged these days to take along a cup with you. So that sums up the measures that were introduced in the budget. We've got a couple of polls that we'd like those of you that are listening in today to have a look at. So the first survey we have is to ask how you feel about the UK economy after this budget. You can participate in this survey now. We carried this out at our budget webinar earlier on, our budget seminar, sorry, earlier on today. It'll be interesting to see if the views are similar. And actually they are quite different. At our survey that we carried out live today, about 60% of the respondents were confident or very confident regarding the UK economy after this budget. The survey that we're carrying out now, should we close it now? We've actually got quite a lot of uncertainty here, approaching 90% uncertainty on the state of the UK economy after this budget. As I say, 60% when we held that live today. Our second survey, a little bit controversial maybe, do you favour a second referendum on EU membership? Straight yes or no answer on this one. So how would you feel about a second referendum on EU membership? Again, when we asked the attendees at our budget seminar earlier today, quite close to the actual EU result, we had 53% would like a second referendum. And in our poll today, should we close that now? Interesting, so we've got a 60-40 split, 60% of the people listening to this webinar now would like a second referendum on EU membership. Thanks for participating in those. So we'll wind up now. It remains for Phil and I to thank you very much for taking the time to listen today. The webinar will be available for you to download on YouTube if you would like to watch again, and please do share it if you'd like to do that. For any tax or business related questions that you have, please get in touch either with Phil Snell or myself, or with your usual James Cooper Preston contact. Thanks very much everybody. Goodbye.